Welcome to the Deep Dive, where we cut through the noise of earnings calls and get right to what truly matters. Today, we're dissecting Eldorado Gold's second quarter 2025 results.
Yeah, this was an interesting one. An intraday call held smack in the middle of market hours yesterday, August 1st.
And the market clearly had a strong reaction to what management had to say.
That's right. We're going to break down the key financials, dive into their operational performance across their various mines, and really examine the strategic moves that are setting the stage for their future.
It's fascinating, the immediate market action.
It really is. A noticeable positive sentiment despite what, initially looked like some mixed headline numbers.
Exactly.
So we're going to unpack why the market perhaps saw past those immediate figures and what really drove that optimism.
All right, let's start by laying out those headline numbers because there's a bit of a paradox here.
Definitely.
On the top line, Eldorado Gold delivered a robust revenue beat. Came in at $451.7 million.
Which was significantly above consensus,
right?
About $404 million.
Yeah, $404.4 million. So an impressive 11.7% beat. And get this, a massive 52% jump compared to the same quarter last year.
Huge jump. And that's where the plot thickens, like you said. Because while revenues soared, the bottom line told a slightly different story. Adjusted earnings per share came in at 44 cents.
Okay.
Which actually missed the consensus of $2.48 by about 8%.
So clear revenue beat, but an EPS miss.
Exactly. Yet, as you mentioned, the share price moved up yesterday, closed up over 2.4%.
Right.
Which immediately signals that the market is looking beyond just short-term profitability.
That has to be.
Yeah, the real insight here is maybe how deeply investors are prioritizing those future growth projects and strategic moves over the immediate earnings number. It's almost like the market views their pipeline, especially Skouries, as a kind of call option on Eldorado's future value.
That's a crucial distinction. And beyond the pure financials, we also saw some solid operational figures.
Right.
Gold production for Q2 was 133.8 thousand ounces. Their all-in sustaining costs, AISC, that's basically everything it takes to mine an ounce and keep the operation going long-term, stood at $15,520 per ounce.
Which is, something we need to watch, but production itself was solid.
And operating cash flow before working capital was robust at $202 million.
Yeah, contributing to that very substantial cash and equivalents balance of $1.08 billion.
So big cash pile, strong revenue, but that EPS miss. Let's really peel back the layers here and understand the underlying story.
Okay, well, if we connect this to the bigger picture, the significant revenue growth was clearly underpinned by a strong tailwind from the gold market, which is a fantastic environment.
Huge tailwind.
We saw a 40% uplift in the average realized gold price they got. It hit an impressive $3,270 per ounce in Q2.
Wow.
So this high gold price environment, combined with higher overall gold sales volume, directly drove that impressive top-line performance. It essentially allowed them to capture much more value from every ounce they sold.
And it's not just about the price they got, though. Interestingly, while revenue surged, production costs also increased, up to $162 million.
Right, up $34 million from Q2 2024.
And what stood out to me was that a notable chunk of this, about 1/3 of the per ounce cost increase, was actually from higher royalties.
Yeah, that's a key factor. So even in this really strong price environment, they're feeling the squeeze from certain operational costs, especially those royalties.
Which leads directly to their guidance, right? That's always a key takeaway.
Absolutely. Management reiterated their 2025 production guidance, 460 to 500,000 ounces. And they specifically expect to hit the midpoint of that range. So production outlook is steady.
Okay, good.
However, because of these higher royalties, their total cash cost and all-in sustaining cost forecasts are now expected to be at or above the high end of their previous guidance range.
Ah, okay. So same production, but costing a bit more.
Exactly. That's an important detail for investors to note. The production target remains solid, but the cost of achieving it is definitely rising.
Right. Shifting to how they're actually performing on the ground. The CEO sounded pretty confident, highlighted that they are well-positioned to achieve full-year guidance and deliver significant production growth ahead.
And the individual mine performance seemed to back that up, mostly. Their Lamaque complex in Canada and the Kisledog mine in Turkey both exceeded expectations for the quarter.
How so?
Well, Lamaque benefited from higher throughput. They managed early processing of a portion of the second Lamaque bulk sample, basically just getting more ore through the mill faster.
Okay.
And Kisledog saw benefits from accelerated inventory drawdown, meaning they processed existing stockpiles more quickly than planned.
And Olympias. They're mining Greece.
Yeah, Olympias saw a strong recovery too, a 35% improvement in gold production, and actually a 34% decrease in costs compared to Q1. So it reached its planned operational levels. A lot of operational wins, despite some of those cost pressures we mentioned.
Okay, so the existing operations are performing. But the big story, and likely a big reason for that market optimism, has to be Skouries.
Oh, absolutely. The Skouries copper gold project in Greece. That's the key strategic element.
And it's still on track.
Firmly on track, they said.
Sure.
First production, Q1 2026. Commercial production anticipated late 2026.
And they mentioned earthworks are even slightly ahead of plan.
They did. Always good news for a major capital project like this. They invested $117 million in the project this quarter, plus another $27 million in accelerated operational capital for self-performed mining. It's clear this project is priority number one.
What's really fascinating about Skouries and kind of where the rubber meets the road on execution is the discussion around its critical path.
Yeah, the complex bits.
Especially the dry stack tailings plant. Now, this is basically the facility that safely processes and stores mine waste, but in a dry, stable form. It's quite an advanced environmental approach.
And complex to build.
Exactly. It required extensive redesign, over 600 concrete pilings just for its foundation.
Huge undertaking.
But despite that complexity, they reported good progress, and the facility is still on track for commissioning in Q1 2026.
And that kind of detailed update on a really complicated piece of the puzzle can instill a lot of confidence,
Yeah.
Shows they're managing the details.
It absolutely can. Which leads to another interesting point that probably caught some ears on the call. Why draw down another $154 million from their project facility when they already have over $1 billion in cash sitting there?
Yeah, that does seem counterintuitive at first glance, doesn't it?
It does. What's the strategic play there? Especially if you want to project financial strength.
It's a great question. And management's rationale was actually quite clear and I think quite smart. It came down to the highly advantageous interest rates on that specific facility.
Ah, so it's cheap money.
It's cheap money. It's a savvy capital allocation decision. They're effectively taking advantage of cheaper debt now to fund the project rather than using their own cash, which gives them flexibility, or potentially having to take on more expensive debt later.
Okay, that makes sense.
And from a broader capital allocation view, this financial flexibility also enables them to aggressively pursue their normal course issuer bid, the NCIB.
The share buyback program.
Exactly. For those unfamiliar, NCIB is essentially the company buying back its own shares from the open market. It's usually a strong signal from management.
Right, that they think the stock is undervalued.
Precisely.
And speaking of that NCIB, they were active. Eldorado repurchased 2.17 million shares for about $44.6 million in Q2 alone.
And another $0.68 million bought back after the quarter ended.
And the board reapproved and even expanded the program to include the New York Stock Exchange now, too.
Yeah, which really reinforces their confidence that the shares are undervalued. And it signals their strong belief in future free cash flow inflection, once Skouries comes online and starts generating significant revenue.
It's a tangible way they're returning value to shareholders while still investing heavily in that future growth.
Definitely. We also heard some important updates on Kisledog in Turkey.
Right, the mine that just hit a big milestone.
Yeah, 4 millionth ounce produced. Quite significant. And they discussed an investment there to optimize their high-pressure grinding roll circuit, the HPGR.
Okay, what does that do?
Think of the HPGR like a superpowered press for rocks. You want it to squeeze out every last bit of gold. They're looking to close the circuit with more screening and agglomeration. The goal is a more uniform, finer product, which should lead to better gold recovery.
Makes sense. More efficiency.
Right. And they're also accelerating the expansion of the secondary crusher circuit that should debottleneck operations and reduce wear and tear on the HPGR itself, which, can cause costly downtime.
So potentially more throughput, better recovery, maybe even extend the mine life.
That's the hope. Now, one small hiccup there. A geological study for future mining phases at Kisledog is delayed to Q1 2026. Apparently, they had an issue with the initial drilling contractor.
Okay. Is that a major?
Doesn't seem like it. They've secured a new contractor and are managing the work. So it's a delay, but not a full stop.
Okay. So bringing all these pieces together, what does this actually mean for you, our listener, maybe someone trying to understand this company's position right now?
Well, the immediate market reaction yesterday was certainly positive. Stock moved up during the call, closed higher, and on significant volume too.
Which really suggests that despite that headline EPS miss, the market validated management's overall optimistic outlook. They saw beyond the quarterly noise.
Exactly. And if we connect this to the broader industry, gold is currently trading above $3,350 an ounce. The GDX ETF, which tracks the major gold miners, is up over 52% year to date. So robust sector tailwinds.
The whole sector is doing well.
It is, and Eldorado Gold itself has seen strong total returns, actually outperforming the GDX over the last 1 and 3 months. So they're capitalizing on the strong gold environment. But there seem to be company-specific factors driving that outperformance too.
And this idea of re-rating potential, that seemed to be a key theme.
It really was. With catalysts like the Skouries mill roof and mechanical completion expected in Q4 this year, 2025, and the Kisledog North leach pad commissioning in Q1 2026. There's a clear path, or at least a potential path, for the company to close the valuation gap to its mid-tier gold peers.
What's that gap look like now?
Currently, those peers trade at roughly 1.0 times net asset value, or NAV. Think of NAV as the theoretical value of all their assets minus liabilities.
Okay.
Eldorado is only trading at approximately 0.7 times NAV. So that's a significant discount. They're clearly aiming to close as Skouries comes online.
Makes sense. But there are always risks, right?
Always. It's important to consider the execution risks. We discussed the higher Turkish royalties and general cost inflation. Those are pushing unit costs higher. That's real.
And the Olympias mill expansion delay.
Yeah, that's now expected by mid-2026 due to permitting delays. It's a slight setback, maybe not critical, but still a delay.
But on the positive side.
On the upside, there's strategic hedging. Using those zero-cost collars for 2027 gold cash flows shows a very proactive approach to managing price risk.
Explain that collar again briefly.
Sure. A zero-cost collar is basically an option strategy. It protects them against gold price drops below a certain level, but also caps their upside above another level. Crucially, it's structured so the cost of buying the protection is offset by selling the upside potential, hence zero cost upfront.
So locking in a price range.
Essentially, yes. For a portion of their future production, it gives them some certainty. And that's something many peers haven't replicated to the same extent.
Okay.
And this, combined with their strong cash position and the ongoing share repurchases, really signals management's confidence in future free cash flow generation. They're clearly playing the long game here.
All right, now let's shift gears to our This Is Not Financial Advice segment. This is where we pitch an outrageous but plausible trade idea, kind of like a hedge fund analyst might to an investment committee.
Okay, well, given everything we've heard from Eldorado Gold's Q2 call, particularly the clear runway for Skouries, that strong balance sheet, the active share buyback program, even with the slightly higher cost environment. Here's an idea to consider if you believe in the company's long-term transformation story.
All right, let's hear it. We're seeing a company actively de-risking a major growth project, deploying capital pretty strategically to boost shareholder value, and operating in a really robust gold price environment.
And the market is starting to acknowledge this with the share price action, as we saw yesterday. But you could argue there might be more room to run as Skouries gets closer.
Okay.
Therefore, a potentially compelling trade, again, not financial advice, could be a long position in Eldorado Gold, ticker EGO, via a bull call spread targeting late 2026 expiration.
A bull call spread. Break that down.
Okay. Specifically, we're talking about buying a January 2027 call option. That gives you the right, but not the obligation, to buy the stock at a certain price, let's say a strike price near current levels.
Got it.
But simultaneously, you'd sell a higher strike January 2027 call option. Selling that call helps finance buying the first one.
So you're betting the stock goes up, and not necessarily to the moon. And it limits your cost and risk.
Exactly. It's a way to bet on a moderate to significant rise in the stock, but with a defined maximum profit potential and, importantly, a defined maximum risk. It's generally a more capital-efficient way to express a bullish view compared to just buying the shares outright.
And the logic here, connecting it back to the call?
The logic is pretty straightforward. This strategy leverages that anticipated operational inflection point. Skouries achieving commercial production and really ramping up, ideally by Q3 2026.
Which should trigger that re-rating.
That's the thesis. It should lead to a significant re-weighting and help close that valuation gap to peers we discussed earlier. And the long duration of the options out to January 2027 allows time for the project to truly mature and for the market to fully appreciate the increased EBITDA contribution.
EBITDA being earnings before interest, taxes, depreciation, and amortization, a key measure of operational profitability.
Right. So this spread aims to capitalize on that anticipated upside, but with a defined risk profile. It aligns directly with the company's strategic narrative of transformation growth.
And the strong gold price just acts as a helpful backdrop.
Exactly. The gold price tailwind is a general sector uplift, sure, but this trade is specifically targeting those company-specific catalysts around Skouries that could drive significant outperformance relative to peers.
Okay, interesting idea. So to wrap things up, Eldorado Gold's Q2 2025 results really underscore a company in a significant operational and strategic transformation phase.
Yeah, despite that short-term EPS miss, you had the strong revenue beat, solid operational performance from the existing mines, and crucially, that robust progress on the Skouries project.
And all combined with a confident and seemingly disciplined capital allocation strategy, buying back shares, using cheap debt. It clearly resonated with the market yesterday.
They're navigating the cost challenges, the project complexities, but while maintaining a clear vision for long-term production growth and value creation. Skouries really remains the central driver for any future re-rating, with those key milestones now firmly on the horizon.
Okay. And just a reminder to everyone listening, the information discussed today is purely for informational purposes. It is absolutely not financial advice.
Please, always do your own research and consult with a qualified financial professional before making any investment decisions.
Definitely.
So, as we close, here's maybe something for you to ponder. How might Eldorado Gold's strategic hedging, that proactive approach to managing project finance, combined with its continued focus on these long-term, high-potential projects like Skouries, how might all that position it uniquely within the gold mining sector if global economic conditions were to create unexpected and maybe prolonged volatility in metal prices over the next few years?
Interesting question to think about. That's it for this deep dive. We encourage you to continue your own research and analysis. Until next time, stay well informed.